Have you listened to episode 26? If you did, you know that we talked about annuities and we started that whole conversation. Today, we're going to continue that, and I think you're going to love it.
So we're calling this episode Annuities Part 2. And quite honestly, it's going to take us through quite a few shows to cover all the different things on annuities. But I think you're really going to understand annuities better as we walk it through. So we're very happy to be able to share this with you, and we hope you enjoy it. We've been talking to you here recently about this idea. If you have questions about your retirement or about your retirement plan, please reach out to us. We have created a way for you to be able to send us a text. So we actually have a texting line. The number for that is 984-207-1753. Send us a text with any questions you'd like for us to ever consider in the future, and we will do our best to cover it on future episodes. But for today, we hope you enjoy Annuities Part 2. On today's episode of what we call Retirement in Action, we're picking up a topic that we had a conversation with you about on episode 26, which was on this idea of understanding annuities. And so we are really calling this Annuities Part 2 for that conversation. If you've not had a chance to listen to episode 26, you're going to want to go back and listen to that. But we're going to kind of bring you up to speed where we are. But if you hear some things today and you go, how does that make sense, or how does that work, and you didn't listen to episode 26, go back and listen to it. But here, what we want to do is recap with you what the world of annuities looks like and why a person might look at annuities. First and foremost, we use annuities if we're going to ever use them in a portfolio for one of two major reasons. One is income planning. We believe that annuities are a good way to deal with income planning. The second one is safe money alternatives. Now, when I say that, what I'm saying is it's an alternative to something like a bond or something like CDs. We believe that this is an alternative to those type of places. And when we're talking about income planning, if you remember in episode 26, Merce and I talked about really two types of income, our essential needs and our wants. We believe that essential income needs should come from places that have guarantees attached to them. We talked about 4 locations that could happen. Number 1, CDs. 2, money markets. 3, treasury bonds. And the 4th area is fixed annuities. And we said out of all of that, where do you think people have the most questions? Fixed annuities. And so just to recap briefly, there's really 2 main worlds of annuities out there. Big high level categories. First and foremost, an immediate annuity. Immediate annuity is the oldest type of annuity out there. It's where you convert a lump sum of money into a cash stream, an income stream that you cannot outlive. Example we used was you put $100,000 into an immediate annuity. It converts it into $500 of income that you cannot outlive for the rest of your life. Sounds good, but it is irrevocable. You cannot go back to the insurance company and say, hey, I need some more money. You're going to have that income stream that you cannot outlive, but there is no account out there. And because of that restriction, a lot of people wanted something different. And so the industry created what are called deferred annuities. With a deferred annuity, I put my money into an annuity, I defer it until sometime in the future, and I can walk away after that deferred period in most cases, or I can take an income stream. So I have some options there. I do have an account with money in it, so I can go get more money if I need it. Now, in the deferred world, there are 2 major types of deferred annuities. One, we mentioned briefly, which was variable annuities. A variable annuity is where I put my money into an annuity, and then I invest in things like a mutual fund. So I have stock market risk within a variable annuity. Now, in the variable annuity world, they have added riders to them that can guarantee me income streams, but it's going to add a lot of expense to it. And we see a lot of variable annuities out there with riders on them that have expenses of between 3 and 5% a year. Now, you think about that, that's 3 to 5% a year, whether you're making money or not. So if the market's flat, you're going to be down 3 to 5%. If the market's down 5, you're down 8 or better % in your in your annuity. On the other side of the world are what are called fixed annuities. So if Merce and I are talking to somebody about a safe money alternative or an income plan, we are going to be in this area, fixed annuities. It means that the annuity company, the insurance company, guarantees my principal. They say that I cannot go below my principal unless I do it based on withdrawals, meaning pulling money out of the account. Now, my interest is going to get credited in one of two ways. There's two types of fixed annuities. One is a declared rate. That's where I actually put my money into the annuity. I'm going to get a fixed rate of return for a period of time, and then I can walk away or take income. Kind of looks like a CD. On the other side or in the middle is what's called an indexed annuity, and that is where I get my interest credited based on an index. So if the index, let's just think of something that everybody would know, like the S&P 500 is positive, I can make interest that year. If the S&P is negative, I don't. Now, that's probably lots of questions, right? So Merce now is going to walk us through a methodology that you need to understand when it comes to that interest crediting within an index annuity. So Merce, can you explain to us what you want to talk to us about when it comes to interest crediting?
Yeah. So there's a few nuances when it comes to understanding the fixed index annuity and how the interest is credited. And so for today's episode, we want to take it very high level just so you can understand one little thing, and that's basically called the annual reset. Now, remember, Radin said that when you go into these index annuities, you're basically linked to an index like the S&P 500, the Dow, the Nasdaq, and there's a plethora of other ones out there. But for this example that I'm going to take you through, let's just call it the index. And what we're doing is essentially we're following the index, and then there is a rate of return that's going to be associated with that index. So I'm going to walk you through some numbers as cleanly as I can, but let's just say you put in $100,000 into a fixed index annuity, and it's linked to an index. And let's say you do it at the beginning of this year. So January 1st of 2020, you put in $100,000 into this fixed index annuity. And now we get down the line, and here's where annual reset comes into play. So we get down the line, and we are now 1 year in to the annuity, January 1st, 2021. And so we get our first annual statement, and we are told that the index has credited us 5%. So simple math on 100,000, you now have $105,000. Now it's called a reset because now you start over, not in the sense of going back to $100,000. You start over from now where the index is on January 1st of 2021 and where it ends up on January 1st, 2022. So it can be up, it can be down. That's really what the annual reset is. It's just monitoring whatever index you're attached to from one point to another point. So let's go down the line again. So we're January 1st, 2021, and we have $105,000. We just made $5,000 in the previous year. Go down the year again, and the index does well, and we get our annual statement in the mail from the insurance company, and they say you've earned another 5%. So we are now at 110,250. Once again, just one more year down the road. Now, here's where the beauty of the annual reset and the fixed index annuity comes into play. The insurance company, like Radin said, is offering up some guarantees, right? So one of the major guarantees and a huge reason why we like these products is basically what the insurance company says is that if there is a period of time and if there's a time where the index is negative for your annual reset or that 1 year period, the index is negative. Well, in the stock market, if you were invested in that index, you would have fallen with that index. So let's say the S&P 500 and it fell by 30%, you would have fallen 30%. What the insurance company is saying is, well, we are going to guarantee that in any downside event, the worst you can do is make a zero for that index period for that year. So let's go back to we now have 110,250 after being in it for a couple years, and we run into a period where the index falls significantly or even a little. And so we get down the period, and the year is now over. So now we're January 1st of 2022. Um, and the index has, say, fallen by 10% or 20% or 30%. Well, if you're in the stock market, you're really worried. In the fixed index annuity, you've made a zero for that year. So your 110,250 at the beginning of the year is still exactly 110,250 as you get your annual statement. So very powerful thing there. You cannot lose money due to market volatility in a fixed index annuity. Now, here's another powerful part is that let's say you were in the stock market and you lost that 20, 30%. Well, it's going to take you a while to get back to that break even. Well, the power of not going backwards in this fixed index annuity is you're still at that 110 to 50. So even if you make in the next year that 5%, the index does well, you're credited 5%, you're well ahead of that stock market like investment. So once again, let's say you have that 110 to 50, you've made 5%, you're now at 115,000. Whereas if you rode the market down in the stock market, you're not no way near as close as at this point, unless the market had a 100% year in all essence. So a lot of power there. Still a bunch of different things that we want to go through in future episodes, but all we wanted you to understand at this point in time is how the annual reset works. Once we have laid the groundwork for this, as we go down the road talking about different things when it comes to crediting methodologies, when it comes to income riders, the annual reset is the basis of how everything works in the fixed index annuity world. So that's all we've got there for you.
All right. So we will have more episodes coming in the future that'll walk you through maybe a lot of the questions you have, but we know that you might have questions now, and you might be thinking that you're getting close to, or you're already in retirement and you're thinking, I need to get some more information about how to do this. We encourage you to go listen to and watch our 4 steps to secure your retirement video series that Merce and I have recorded. You can access that by going to our website, which is pomwealth.net/podcast. And there you'll be able to see how you can access that mini video series. We take you through a series of different videos to help you think through a lot of these different things. Again, don't forget, if you listen to this and you're thinking, trying to connect the dots, go back and listen to episode 26, and you'll be able to hear part 1 of the annuities conversation. And then we look forward to sharing with you more about annuities in the future so that you can understand how this all works. But thank you very much. We appreciate you listening to our podcast today.